We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Lance Lewis, president of Lewis Capital. He also runs a gold and gold equity strategy and is the publisher of the dailymarketsummary.com. Thanks for joining me today, Lance.
Good to be here.
So, as much as things seem like they've changed since the last time we spoke, we were talking about that before we hit record here. It's been since January that we spoke last, and gold was actually higher then. So as crazy as it is to think about, everything that feels like it's changed since then, we were mentioning before we hit record that there's a lot that also hasn't, right?
Right. It's funny. I mean, I know back in January, I was bearish at the time, looking for lower gold prices, and the theory being at the time that the equity market would potentially break as well, and you would get one of these, events to the downside. I was right about gold, but I was dead wrong about the equity market because it kept going up, and gold dumped into the March low, and my model actually turned bullish at that point, and then we got a nice rally into June. But since then, the downtrend has resumed, and if you look back, you basically since August of 2020, you've been in a bear market in precious metals and precious metals mining stocks. Unfortunately, it just kind of is what it is. I guess the question is, how is that going to change and when is what everybody wants to know.
Absolutely. And of course, we're talking here on the afternoon after market close of October 26th. And as we saw today, gold has given back some of its gains from this recent rally that took it above the $1,800 level again. And in your writing, you've talked about this compression triangle in gold. So what is this compression triangle and what is it telling you right now?
Well, it's just a technical formation here. We can pull up the chart. It's right here. So you can see in green is basically the most recent one. You had a larger one that has since gone away. But you broke out to the upside on Friday and then, oddly enough, closed right back in it after you turned over, after Powell said exactly what he said before. There was no new information there. Mm-hmm. That's why that was a little odd. But there again, the question was that an excuse for something that the market was going to do anyway? I suspect probably so. But then yesterday, we finally closed outside of it for a day. We didn't take out Friday's high. And then today, you can see we've drifted back towards you. You didn't close. It's hard to tell on this chart how exactly. You kind of closed right on it. And let's see, were you back below you're just above the 200 day, it looks like. No, actually, you're a nickel below it. Not that I think a nickel, dollar here or there doesn't really matter. But it's just another, with these compression triangles, a lot of times what will happen when you break out of them, if you don't immediately accelerate and rip higher, or conversely to the downside, same thing, you'll get what's known, the commodity traders call it a first way, wrong way move. So first way seems to be breaks out one direction. That's the wrong way. It actually breaks in the opposite. And I don't know if that's indeed what's going to happen or not. But like I said, it's a common thing that happens. Mm-hmm. But just going back to, like I said, basically, sadly enough, gold's been in a bear market since August of 2020. Had a nice rally here into June. And then since then, you've kind of basically resumed kind of bear market action, 200 days going down, 50s below the 200. You tried to kind of triple bottom at this, 1670 level that we hit back in March. But, the question is always, so as all this has been happening, everything else has been melting up. Commodities, stocks, Bitcoin, everything. Everybody's talking about inflation, yet gold trades bad. So the question is, why is that? Whenever something doesn't act like it should, that should always, make you wonder what exactly is going on. And, I can remember this happening, oddly enough, back in 2013, when the Fed was similarly doing QE and gold started going down after December of 2012. And that did not turn out well. And not that this is 2013, but the fact that gold trades the way it does, given the environment and the sentiment around inflation, is not positive in my view. It doesn't mean it's going to crater $200 tomorrow, but it's just, it doesn't act right. I think I remember I said the exact same thing back in January. It didn't act right, and sure enough, it went lower. Mm-hmm. So unfortunately, I think this is going to have to end either with. There's two ways I've seen gold bottom over the years in my career. One, it ends with the spike to the downside in a calamity, basically, where everybody panics. Or B, you get a sell-off and then it just kind of drifts sideways for a couple months and just everybody kind of loses interest. It doesn't go down, doesn't go up, just kind of flops around. Same with the mining equities. And then all of a sudden, for no reason, they take off again. But I think you're probably looking at something like that. And if you look, here we can go back to that real quick. Hang on a second. Since June, each one of these little rallies that we've had, this one started at the end of July, basically ended and collapsed about 30 days later, roughly, more give or take. Mm-hmm. This rally began early August. It ended the end of September, collapsed. So it ended about 30 days later. Well, here this rally began the end of September. Here we are. You're in that 30-day window now between now and the FOMC next week, where the pattern doesn't have to play out the same. It could be different. Mm-hmm. But the fact that you've not accelerated to the upside after having broken this downtrend, and everybody, you broke the downtrend. GLD's holdings actually went down on Friday again. Another new low for the year. So you're in a zone of danger, I think, over the next, let's call it 7 trading days, 10 trading days, whatever, going into the FOMC. And, with the dollar index now starting to head back to its high, could make for unpleasantness next week. Mm-hmm.
Well, today was also an option expiry day. So why does that play into this downward pressure for gold and gold equities as well?
Well, it doesn't necessarily have to necessarily. Okay. But a lot of times, if the trend was to the upside, you would see the expiration potentially make that move, accelerate to some degree. Mm-hmm. And the same thing can happen when its price is moving down. But if price moves up and then it drops back on the expiration, a lot of times that can be kind of the end of a move. Mm-hmm. So, it doesn't have to be that way. It's noteworthy that expiration occurred, and what did price do? Sometimes it doesn't do anything; it just sits there. But in this case, we had broken out yesterday, should have gone, and it didn't, and so that's potentially troubling as well.
So, Lance, you mentioned that we have this upcoming FOMC meeting on November 3rd here. So, every time we see some news come out for gold that should be positive, inflation expectations are higher than the Fed thought, or in this case, Jay Powell is supposed to announce the tapering schedule for QE, and gold doesn't react the way we traditionally think it should. What is that a sign of for you?
Well, it's the fact that everything else is melting up and everybody's talking about inflation, and we just had the Twitter CEO over the weekend talk about hyperinflation, yet gold can't even sustain more than a day above 1,800. So, and that's not to disparage gold, it's just that's telling you something. The marketplace, for whatever reason, gold, unlike zinc and copper and all these other industrial metals that are GDP sensitive, it's a monetary metal. People express their view of what the monetary environment is going to be in the future in gold. If you go back to March of 2020, when the Fed said we're going to do 120 billion a month and everybody's debts are good, gold took off immediately. Oil, however, a month later was negative, still going down. So you can get these things that where they diverge for a while. And I think the fact that it's knowable that the Fed's always going to try and pull back accommodation once the economy looks firm enough to handle it. And with the S&Ps at a new all-timer again today, they don't exactly have any pressure on them not to remove accommodation. So they always try, and historically they try until something breaks. And then when something breaks, they stop and reverse. So the fact that gold is not acting like it should, I think tells you that yes, A, they're definitely going to taper. B, they might actually do it faster than people anticipate because there's no reason not for them to. And at the moment, important people in government are begging them to remove it. And even, a lot of Wall Street strategists are begging them to remove it. So, like I said, with the S&Ps at an all-timer, economy doing well. I mean, sure, job growth is not exploding. We'll get this month's number at the end of next week, coincidentally. But things are pretty good. If they're going to do it, hey, now's the time.
Mm-hmm. Until something, looks like it has been broken. Yeah.
Yes, exactly. Then all of a sudden, whoa, wait a minute. Sorry about that. Yeah.
So
that's going back to why I think the way, and I don't know if it's, 2 weeks from now, 6 months from now, or a year from now, but eventually wherever gold hits a low that is a low that matters other than just for a rally, it's going to be probably coincident with the equity market going down.
So when we're looking at these important levels from a technical standpoint, Lance, why does the 200-day moving average hold so much weight as a benchmark to measure against?
That's a good question. Just enough people watch it that it seems to have importance. Is it any more important than the 300-day moving average? I have no idea. But enough people watch that 200-day that it's psychologically, and it's a moving average. It tells you something about the price where people own it, and whether it's above or below, the number of days that people have owned it at that, for 200 days. So it's just a common moving average that's important, and the fact that it is trending down in gold at the moment doesn't tell you that the price can't go up. It just says that the trend at the moment, the intermediate trend, in addition, because if you think of longer term within the last year, is down, even though the short-term trend since the end of September has been up.
So when we look at the relationship to gold, or some of these relationships to gold, how do real yields fit in there, and how closely do you pay attention to yields when you're deciding to enter a trade?
Well, when gold really stopped reacting to real yields back in August of 2020, because real yields actually continued to move lower. But historically, once they get this low, gold it doesn't react to them anymore the way that it had. And then any turn to the upside, however slight, gold tends to react dramatically to the downside. Just a function of, if you're a nickel away from zero, how much closer to zero can you get? It can only go to, as opposed to being $10 on its way to zero. So I think it's a function of just where they are, where real yields are.
Mm-hmm. So how is the copper to gold ratio instructive for you to determine where yields are heading?
Well, historically, oddly enough, the copper gold ratio has tended to forecast where the 10-year note yield is going to go. Now, there's no rule that says that has to be the case. It's just historically that's been a good correlation. Mm-hmm. And just here over the last couple of weeks, we had a spike up in that ratio to the upside as copper, neared its all-time high, and gold did not. But since then, that ratio has actually fallen back again. So what it may suggest is that yields in the long end could spike to the upside here in the next month or so, and then turn back over and come down again. Could be potentially what that is suggesting. And perhaps that's because the Fed does announce a faster than expected taper, and the initial reaction is bond yields spike and equities and commodities turn over, but then equities and commodities keep turning over, and then yields come in at that point. It's one possibility.
So in that case, Lance, are yields still a major factor in your gold model? And can you share with us some of what the other factors are that go into this gold model?
They're the DSI, the HDNSI, the COT, moving averages, a bunch of other stuff that's complicated, but it's got a lot of different components to it. Let's just put it that way.
Mm-hmm. So is it
at the moment it's neutral, and that's kind of the way it operates. The last time I got a sell signal, an actual sell, was in August of 2020, and since then, each one basically would have, in hindsight, been bear market rallies. I've got what is the weakest buy signal I can get, and then that inverted back in July. So in other words, and this happened in 2018 when we started the downtrend into that September low in 2018. I was getting tier 3 buys. The price kept moving lower in GDX and gold. So it was almost, the bear market was so strong that the buys didn't matter, and it inversely became a sell. And we've seen that, I think, 3 different times since July. Now, the most recent one, actually, I did get on the low and it worked. But the prior 3, I didn't trust it because the prior 3 just indicated more selling. Mm-hmm. But it's been, you've had a straight up move since the last day of September, at least in the mining stocks. The gold's been more labored. But it's nothing. The GDX has been above the 5-day moving average every day for the month of October, including today still. So, as long as that trend continues, you'd argue, give the benefit of the doubt to the upside, but that kind of move is more indicative of a squeeze in a bear market rally than a bull market one. If you go back and let's say the rally that off of the 2020 low in March, you broke that 5-day numerous times on the way up, where you got little head fakes downside, sucked in some sellers, buyers came in, took off again. But this just relentless, where you're above the 5-day every day. It's fun, but if you look back historically, it doesn't tend to last. It's kind of the candle that burns at both ends, burns half as long.
So is this kind of the same reasoning that, when you get these tier 3 buy signals that your model puts out, is it a kind of bearish signal that many of them get sold on top of that?
If typically the way it works, if the model gives a tier 3 buy, now this doesn't happen with tier 1. At least I've never seen it happen, and when I back tested it, it's never happened. It could happen in theory, but when the tier 3, when I get it, if price doesn't immediately move higher the next day, it's actually a bearish signal. Like, for example, back in, was it July or August that we got the employment report and gold got hammered? I think it was July. It was like late July, early August. Anyway, the day before, I got a tier 3 buy, the day before that jobs report. Mm-hmm. And it looked like, well, you're going to turn higher. Instead, gold lost like $50 the next day. Whoa.
Yeah, I believe that was August 8th.
Yes, that was the day. Yep. And I know I got caught in that as well. And because I'd had tier 3 buys in late June and early July, and price did turn up. The equities, the mining stocks rallied like they had before, although there was a curious divergence at the time between the gold price and the mining stocks, even then, where they actually underperformed, didn't act like it normally does, which was actually a heads up to something's wrong. But that would be, and in that particular case, that was clearly a bearish signal, and it was bearish for the next, 2 months, especially in the mining stocks, which went nowhere but down, even when gold rallied.
Mm-hmm.
So yeah, so I mean, from the standpoint of you kind of have to know how to read the model, within the environment. It's not just a,
red light, green light,
green or red sign that tells you to do something. You kind of have to interpret it a little bit. I wish it was more simple than that, but it's not.
Mm-hmm. So Lance, can looking at the price of gold in other currencies be helpful to you in any way?
I mean, I think it is. I look at it, every day in the major currencies just to see what it's doing. Oddly enough, it looks about the same as it does in dollars. And not a whole lot's going on except a little bit in yen. But I look at it, but it's not something that I add a tremendous amount of weight to.
Mm-hmm. So as we've seen the miners seemingly come to life here since the end of the third quarter, you said that you don't exactly have a reason for this, but you said that one of the reasons that you said could have been that they have simply become too short. So can you explain the reason for that?
Yeah, basically it got to where going into the end of September, they went down so easily that I think the market just got too short because it was too easy to short them. Because it didn't matter if gold was up or down, the miners seemed to go down every day. And it was and when things get that easy, you a lot of times get a reaction the other way because people have gotten too short and they then get squeezed. And a lot of these moves and a lot of these equities look like short squeezes because they've just been kind of straight up. I mean, you basically, all you've done in most cases, at least in the indices, is retrace the damage that you did in September. So there again, it looks like a squeeze to me, and there's kind of another bear market rally. It's a nice rally. I mean, nothing to shake a stick at it, but that's probably all it is. And the telltale will be, I guess, if you see what happens if gold does fail where it is now and potentially move lower from here. What do the equities do? A hopeful view would be that potentially gold breaks and joins silver, platinum, palladium, and takes out those March lows with some sort of spike. But the mining equities don't make new lows, and you get a bullish divergence, and it could work that way. That would be something you'd want to see, but until it happens, there's really no reason to do anything until you see it.
Mm-hmm. So when we think about the S&P, Lance, you mentioned that it made a new all-time high again today. You've said that it could already have moved into the autopilot position for the upside for the end of the year. So what is that autopilot position as you see it?
It's just the seasonal tendency for the stock market is once you get through October, you kind of go into this autopilot to the upside where it was into the holidays. There's been a couple times that I can think of that it didn't happen that way, but it's generally 100% of the time, that's pretty much what happens. Mm-hmm. And that's the interesting thing, because that in theory, these other central banks are starting to move towards tightening as well, especially in the UK. And yet, the dollar is rallying against all those currencies. We have an ECB meeting actually on Thursday, and we'll see what they're going to do or not do. But that's the other interesting thing about what's happening right now with the dollar and gold and commodities. That you do have this period where the commodities and the dollar are rallying together, which is unusual. It doesn't happen very often, but historically, when it does, what tends to happen is commodities turn over, and then the dollar the rally accelerates. So you actually get an outsized, when you have this commodity and dollar move together, the outsized move is actually in the dollar to the upside. And I guess the reason for that is probably because the inflationary pressure of the commodities forces the Fed to tighten faster than they would have otherwise, which is what propels the dollar to the upside. So people may just be looking forward in that, not only is the Fed going to taper probably faster than people think, they may even get some interest rate hikes in there quicker than people think until the S&Ps crack 30%, and then they'll stop.
Do you think it's really going to take 30% for them to cry uncle?
Something around that number, probably. And I mean, it doesn't have to happen in 2 days. It can happen over, a month and a half. But I think you'll have to have some type of significant break to the downside before before they'll react. That's just, I mean, they've always been that way. It's just they're slow moving. Just like you look at, I mean, what was the percentage decline in March 2020 before they finally lifted a finger?
Yeah, it was something like 30%. Yeah.
Yeah. And the selling was 3 or 4 weeks long. Mm-hmm. So I mean, they fooled around. I remember T-bill rates went to 0, and they didn't do a thing. It just, it takes them a while. They're slow.
Mm-hmm. So is that where you see the biggest risks for the general equities right now, Lance? Is the actions of the Fed coming into the tapering announcement?
I don't know if necessarily next week is going to cause any problems for the S&Ps, but I think eventually, as the Fed withdraws that stimulus, and people start looking forward to rate hikes, whether they get to them or not, I don't know. Mm-hmm. That's going to cause problems for the equity. I mean, historically, that's what always causes problems for the equity market. And then as those problems begin, it usually unveils other problems that were there all along, but that got covered up. You think back to 2007. The problems in the mortgage market. That's when that first broke, and the Fed, they were tightening right into it and had no clue. And then and then that unleashed or catalyzed those problems, which then led to 2008. But it always starts with them trying to remove accommodation.
So when we think about, you're looking at this stuff every day. Are you seeing anywhere that, you can give our listeners some ideas of where to actually look to make trades and make money right now?
In the short run, oddly enough, it's probably a good trade on the short side in gold, and even, and to a lesser extent, the gold equities, maybe more, I don't know. But I think you're near the end of this kind of 30-day window that gold's typically rallied in. It's showing signs of failure. Like I said, the equities are also, the GDX rallied up to the 200-day, failed, backed off. It's still above the 5-day, so in theory, it could take off again. But if you break that trend and it does fall back below the 5-day, you're going to get some kind of downside. And with the dollar starting to rally back towards its highs going into next week, it's just, a lot of these commodity indices that have been hot have turned over here in the last week or so. So in the short run, it seems like you're going to get some sort of downside, which is either A, worth hedging against if you're long, or B, worth trying to make some money off of if you want to try to go short.
Mm-hmm. So when we see commodities like zinc, for example, 2 weeks ago, it made an all-time or a new all-time high. How does this play into your inflationary outlook? Is this something that gets resolved with supply chains returning back to normal? Or is this, a cost that will persist just as any other commodity input that will ultimately drive PPI up?
Well, I mean, it's my belief that the inflation we have is not transitory necessarily, but it is highly dependent on monetary policy. So, and then there's also some supply components in there as well. But as the Fed does begin to back off stimulus, that's going to matter. Just like when they hit the accelerator, it mattered. It took some time. There was a lag. That's the way it works. It's going to work the same way as they back it off. So in the short run, I don't think the inflationary pressure is going to remain. But as they begin the process of pulling back on QE and eventually tightening, I think you are going to see that inflation turn over. Now, if you look at for example, I think the oil price is 85. Let's say that makes it up to 95, turns over. As like I said, as inflation turns over, the oil price comes back to 70. That's a pretty big decline. But then, they go, oh, the Fed says, well, wait a minute, sorry about that. We'll actually start doing more QE, and they hit the accelerator again. Then oil starts back up again, and potentially makes new highs above that price. So it doesn't necessarily mean that inflation is over even once things turn over. I just mean in the bigger picture, I guess, I think you're closer to the end of this push in inflation than you are to the beginning of it. Let's put it that way. Not that, like I said, it ain't going to end tomorrow, But it's just, if you think about this has all been developing since April of 2020. If you were bullish on inflation, that was the time to be. Now everybody's talking about it. It's on the headlines. Everybody and their mother, the kid down the street knows, yeah, we got some inflation. Mm-hmm. That's not the time to get really, really long inflation.
Right. So as we recently saw the story from CNBC titled "Fed to Ban Policymakers from Owning Individual Stocks, Restricting Trading Following This Controversy," do you think that they should have been banned from doing this all along?
Yes. I'm ashamed to say I thought they were. I mean, I think that's amazing that they could even do that. That's nuts. No question about it. Here, that you can go out and buy anything in the financial markets where they say a certain word and prices can move 4 or 5%. That's crazy. Mm-hmm.
Yeah, it really makes you think about the incentives going into that job, right?
Yeah, I mean, if you just like if a CEO of a company were to say something positive about his stock and he were able to do a trade and some calls right before then, of course that's illegal. Mm-hmm. So why is it that these Fed guys can go out and trade stocks, ahead of policy moves that they know are coming? Mm-hmm. That's nuts.
Absolutely.
It's not. I guess it's actually not all that surprising.
True. All right, Lance, is there anything else you'd like to add to our listeners before we wrap up here?
Just that, like I said, I think the next 10 days for gold and the gold mining equities, I think will be interesting to see if you do indeed, if you're in that window to where this rally is potentially going to end, what does the end look like? And do you get any type of divergences? Do you get does gold sell off enough to finally join some of these other precious metals if it does sell off, and what potentially sets up after that?
Mm-hmm. Excellent. Well, something to look forward to. Of course, you're available on Twitter at Lance J. Lewis and dailymarketsummary.com. Anywhere else you'd like to point to, Lance?
Nope, that's good enough.
Perfect. Thanks for your time today.
All right, take it easy.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.